Something very significant just quietly emerged from Washington, and you are not going to want to miss this. This just came out, and people are reaching out about this in overwhelming numbers right now, asking what it means for their retirement savings, their tax bills, their Social Security income, and the financial plans they have spent years carefully building for themselves and their families. There are multiple developments happening all at once right now, and if you have a retirement account of any kind, if you receive Social Security benefits, if you are still working and contributing to a pension or a 401k, or if you are living on a fixed income and trying to make every dollar stretch as far as possible, what I am about to share with you touches every corner of your financial life directly. A quiet but potentially sweeping tax proposal has just surfaced in Washington, and it is already changing the way financial planners, retirement experts, and senior advocates are thinking about retirement planning strategies for millions of older Americans. Stick with me because I am going to walk you through exactly what this proposal says, who it affects most, what the experts who study retirement and tax policy for a living are saying about it right now, and what it could mean for the money you are counting on in your retirement years. I am going to explain every piece of this in plain, simple language with no tax jargon and no political spin, because what you need right now is clear, honest information delivered straight to you without confusion. If you are watching for the very first time, welcome. We cover these developments every single day so that seniors, retirees, and everyone living on a fixed income across the United States and Canada always have the clearest and most current picture of what Washington is doing and how it directly affects the money you depend on. Make sure you stay all the way through to the end, because near the close of today's update, I am going to share something very specific that most financial media outlets are not talking about at all regarding how this tax proposal could affect people differently depending on the type of retirement account they hold and how close they are to their required minimum distribution age. That distinction matters enormously, and it could change the decisions you make about your money right now before anything is even finalized in Washington. So let us build the full picture together starting from the very beginning. To fully understand why this tax proposal is generating so much attention and concern, you need to understand the current tax landscape for retirees and retirement savers, because that context is the foundation of everything that follows. Right now, the American retirement savings system is built around a concept of tax deferral. When you contribute money to a traditional IRA or a traditional 401k, you typically get a tax deduction up front, meaning you do not pay income tax on that money when you earn it. Instead, you pay taxes later when you withdraw the money in retirement. The logic behind this system is that most people are in a lower tax bracket in retirement than they were during their working years, and so they end up paying less total tax overall. This system has been in place for decades, and millions of Americans have built their entire retirement strategy around it. Decisions about how much to save, which accounts to use, when to retire, and how to draw down savings are all deeply connected to these tax rules. Now, here is what is happening in Washington right now that is causing so much concern among retirement planners and seniors alike. The new tax proposal that has emerged involves potential changes to several key elements of this retirement savings tax structure. And while the full details are still being debated and negotiated, the broad outlines are already clear enough to raise serious questions. Let me walk you through the most significant elements one by one so you have a complete and clear understanding of what is being discussed. The first element involves changes to the tax treatment of contributions to traditional retirement accounts. Some versions of the proposal would replace the current system of upfront tax deductions with a flat-rate tax credit for retirement contributions. In plain language, here is what that means. Right now, if you are in a higher tax bracket, your deduction for contributing to a traditional IRA or 401k is worth more to you in dollar terms than it is to someone in a lower bracket. Under the proposed flat credit system, everyone would receive the same percentage credit regardless of their tax bracket. Proponents argue this is more fair because it gives equal benefit to lower income savers. But here is the concern that retirement experts are raising loudly right now. Higher income workers and business owners who currently rely heavily on the upfront deduction as an incentive to maximize their retirement contributions may respond to this change by saving less. And when higher earners save less in tax-advantaged accounts, the overall pool of retirement savings in the economy shrinks. That has long-term consequences for financial security across the board. People are reaching out right now asking whether they should rush to maximize their traditional IRA or 401k contributions before any changes take effect. And I want to address that question directly. If you are still in the workforce and still contributing to a retirement account, the possibility of this change is worth discussing with a qualified financial advisor or tax professional who knows your specific situation. I cannot tell you exactly what to do because everyone's circumstances are different. But I can tell you that being aware of this proposal and understanding how it might affect you is the first and most important step. And that is exactly why we are here today. I will keep you updated every step of the way as this proposal develops and moves through the legislative process. Now, let me move to the second element of this proposal because this one is generating even more concern among people who are already retired and already drawing income from their savings. This element involves potential changes to the rules around required minimum distributions, which most people in the retirement world know simply as RMDs. Right now, if you have money in a traditional IRA or a traditional 401k, you are required by law to begin withdrawing a minimum amount each year once you reach a certain age. That age was recently adjusted to 73 under legislation passed in recent years. These mandatory withdrawals exist because the government wants to eventually collect the taxes that were deferred when you originally contributed that money. The withdrawals are treated as ordinary income and taxed accordingly in the year you take them. Now, here is what is being proposed that is causing significant concern. Some versions of the tax proposal being discussed in Washington would lower the age at which required minimum distributions must begin or change the calculation method in ways that would require larger annual withdrawals. In plain language, this could mean that more money would be forced out of your retirement accounts earlier and at a faster rate than current law requires. And every dollar forced out becomes taxable income in that year. For people who are carefully managing their taxable income in retirement to minimize their tax burden and to protect their eligibility for income-based programs like Medicare's income-related premium adjustments, being forced to take larger withdrawals could push them into higher tax brackets unexpectedly. This is the kind of cascading effect that is genuinely important to understand. A change that looks like a retirement account rule on the surface can ripple out and affect your Medicare premiums, your tax bracket, your eligibility for certain assistance programs, and your overall monthly budget. People are reaching out right now saying they did not even know that their retirement account withdrawals could affect their Medicare premiums. And I completely understand why this feels overwhelming. This is exactly why I am here every single day breaking these things down into language that actually makes sense so that you are never caught off guard by a change you did not see coming. I will keep you updated as the specific details of the RMD proposal become clearer in the coming weeks. Now, let me talk about the third element of this proposal because this one affects a group that often gets overlooked in these conversations, but that is a very significant part of our community. That group is people who are between the ages of roughly 55 and 65, who are still working, still earning income, and still trying to figure out the best strategy for positioning themselves financially for the retirement years ahead. For this group, the tax proposal raises a very specific and pressing question. If the tax treatment of traditional retirement account contributions is going to change, does it make more sense right now to shift contributions toward Roth accounts instead? Here is the key difference in plain terms. With a traditional account, you get a tax break now and pay taxes on withdrawals later. With a Roth account, you pay taxes now on the money you contribute, but your withdrawals in retirement are completely tax-free. If the tax advantages of traditional accounts are going to be reduced under the new proposal, the relative appeal of Roth accounts increases significantly. Pay the taxes now under current known rates and enjoy tax-free income later. This is a strategy that financial planners are already discussing very actively with their clients in response to this proposal. And it is something worth understanding even if you cannot act on it immediately. Now, I want to be very clear here because this is important. I am not a financial advisor, and nothing I share in these updates is personal financial advice. What I am doing is making sure you have the information you need to have an informed conversation with the professionals who can advise you specifically. What I can tell you is that the questions around Roth conversions, contribution strategies, and withdrawal timing are all worth putting on your agenda for your next conversation with a financial planner or a certified retirement counselor. If you do not currently have a financial advisor and you are on a limited income, there are nonprofit organizations that offer free or low-cost retirement planning assistance to seniors. Your local area agency on aging is a great place to start. I will keep you updated and I will always point you toward the resources that can help you navigate these decisions without cost. Now let me move to something that connects this tax proposal to the broader Social Security picture, because these two things are more connected than most people realize. One of the revenue assumptions underlying parts of this tax proposal involves the expectation that accelerating taxable withdrawals from retirement accounts will generate more income tax revenue for the federal government in the near term. In theory, some versions of the proposal would use a portion of that additional revenue to shore up the Social Security Trust Fund. That is the argument being made by some supporters of the plan. Now, that framing sounds appealing on the surface. More money going into Social Security sounds like a solution to the long-term funding challenge we have discussed in previous updates. But independent budget analysts and retirement policy experts are raising serious questions about whether the math actually works out the way supporters claim. Forcing larger retirement account withdrawals does generate more taxable income in the short term, but it also depletes retirement account balances faster, potentially leaving some retirees with less money available in their later years when healthcare costs tend to be highest. Trading long-term retirement security for short-term tax revenue is exactly the kind of trade-off that deserves the most careful and transparent public debate possible, and I want to make sure our community is informed and engaged in that debate. Your voice matters in these conversations. When Washington hears from millions of older Americans who are paying close attention to what is being proposed, it changes the calculation for the people making these decisions. I will keep you updated on every development, and I will always tell you how you can make your voice heard when it matters most. Now, let me briefly speak to our Canadian community members, because retirement tax policy changes in the United States have ripple effects that reach northward. Canadian seniors navigating the Registered Retirement Savings Plan system and the Registered Retirement Income Fund rules will find many familiar themes in today's discussion. The tension between tax deferral incentives and government revenue needs is a challenge every modern pension system faces. Trade and economic interconnection between Canada and the United States means that shifts in American retirement savings behavior affect cross-border investment flows and financial market conditions in ways that eventually reach Canadian households as well. I will continue bringing relevant updates for our entire North American community, because retirement security for older adults deserves attention on both sides of the border. Now let me bring today's update to a close with a clear, organized, and honest recap of everything we have covered, because I want every person watching to leave here today feeling genuinely informed and prepared, rather than worried and confused. A quiet but potentially significant tax proposal has emerged in Washington that could fundamentally change retirement planning strategies for millions of Americans. The proposal includes potential changes to how contributions to traditional retirement accounts are taxed, possible modifications to required minimum distribution rules that could force larger and earlier withdrawals from retirement savings, and revenue assumptions that some experts are questioning closely. For people already receiving retirement income, the most immediate concern involves the potential for larger forced withdrawals that could raise taxable income, affect Medicare premiums, and disrupt carefully managed retirement budgets. For people still approaching retirement, the proposal raises important strategic questions about the balance between traditional and Roth account contributions that are worth discussing with a financial professional as soon as possible. Nothing has been signed into law yet. The debate in Washington is active and ongoing, but the direction of these discussions is clear enough that being informed and thinking ahead is genuinely valuable right now. The most important action you can take today is to make sure you understand your own retirement account structure, know what types of accounts you hold, and how they are taxed. And if you have specific questions, schedule a conversation with a financial advisor or a nonprofit retirement counselor. I'm going to be right here every single day, watching every proposal, every vote, every regulatory change and every piece of tax and economic news that affects your retirement security and your monthly income. When something important happens, you will hear it here first, explained in plain, honest language that actually makes sense for real people living real lives and planning real retirements. If today's update helped bring clarity to something that felt confusing or overwhelming before, please share it with someone in your life who needs to hear it: a spouse, a sibling, a friend from your community center or your place of worship. There are so many people in our community who are quietly anxious about their retirement security and just need someone to explain what is happening clearly and honestly. This community exists because you deserve better than confusion. You deserve clarity, honesty, and someone dedicated to watching out for your financial well-being every single day without fail. And that is exactly what we are going to keep delivering for you. Stay informed, stay prepared, and I will be back very soon with the next important update. Take very good care of yourself and everyone you love.